Hello, everyone. Welcome to the Institutional Investors Perspective panel. I'm Chris Solars, who is going to moderate today. And thank you to Dan and the Pentair team for having me on. This panel, I'm going to be joined by Marcos Baramis and Andrew Chen of Lockheed Martin. And this panel is about institutional assets and where we are in the process of institutional adoption. As we know, the real money in crypto will be from the institutional space. I think when public pension funds allocate 5% of their capital to crypto, if and when corporate treasurers consider crypto as part of their capital stack, it will be significantly impactful for crypto asset prices. And probably in this past year, this is exactly why we've seen Bitcoin up 20x from its lows of almost 3,000 in March of last year. It was the institutionalization of PayPal and MasterCard, Mass Mutual, Bank of New York, the oldest bank in the country. So I think this is really exciting to talk with these two institutional investors about their journey and really where they see what inning we are in institutional adoption. So what I would love to do is turn it to my panelists, and I would love them each to introduce themselves, but at the same time, perhaps answer my first question, Marcos. And that's really, can you tell us about your journey into crypto and your journey on behalf of the institutions that you've worked for and how you've gotten them comfortable with crypto and digital assets?
Absolutely. Thanks, Chris. So thank you all for being here today. I'll try to be as brief as possible. We can talk about many things with respect to the institutional world, but I used to work at Cambridge Associates, a large investment consulting firm, for 13 years. And in 2018, we started researching crypto, and I took the responsibility of covering that along with a couple of my colleagues. And we researched the space for a period of 2 years. Now I am with Evanson Capital Management. It's a fund of funds in Chicago, where we're continuing doing work in the crypto space. So that's kind of my brief background there. Now, how did I get into crypto? I mean, there are two journeys I've had. You know, one is the personal journey, and then there's the professional journey. But perhaps I'll give 2 words on the personal journey because that led to the professional journey. You know, I got personally interested in Bitcoin back in, you know, the 15, 16, 17, for the simple reason that I'm Greek. And the 2010s in Greece, for those of you who don't know, were a period of prolonged economic depression. Now, as regards the financial system, things that no one would have expected happened back then. So government bonds were haircutted by 75% overnight. Capital controls were, you couldn't wire funds abroad nor take cash out, haircuts on deposits in Cyprus, and all that happened in the EU. So naturally, Bitcoin as a non-sovereign asset that cannot be seized or controlled, living outside of the traditional financial rails, seemed to me like a very good hedge to have through that experience. Now, in 2017, when I was at Cambridge Associates, you know, there was a bubble then, the ICO bubble. And we were receiving a lot of questions from clients. I don't think anybody was ready to do anything with respect to crypto in terms of investing, but we were receiving a lot of questions. So we discussed coverage of the space, and I actually volunteered to do it because I had a big interest in it. Not many people were interested in doing that at the time. So initially the project was to explore, you know, whether more work was warranted, whether we should be looking at funds in the space. So the first 6 months we spent it reading, you know, mostly I'd say Medium articles. And then we spoke with numerous folks in the industry, from managers to entrepreneurs, to understand what is going on. And then by mid-2018, we had underwritten our first dedicated crypto VC fund. So that's how we started. And at the time, you know, the institutional involvement was very limited. Fast forward to today, I think it's exploded, particularly the past 6 months, and we can get into that in a bit.
Yeah, thank you, Marcos. my introduction to Marcos was from his paper, his Cambridge white paper. I work at Cliffwater, which is also an alternative investment consultant. And over the years, it's funny, up to 2018, there was significant in the client interest, right? Inbound questions, and I was fielding most of them. After the bubble burst in 2018 and crypto plummet and Bitcoin plummeted, there was many less inquiries, and things have picked back up in these past few months. So we're getting a lot more questions from our clients. We haven't moved yet, but I think we are close, and I will be putting out a white paper myself sometime soon.
Great. That's great.
Andrew, I would love to move to you and hear about your personal blockchain journey.
Sure. Yeah. No. First of all, thank you everyone for having us. Very topical. For myself, I'm at Lockheed Martin's corporate pension, mostly covering the hedge fund space. I've been an allocator for close to 15 years, and in a way stumbled onto crypto by accident. But once I started digging, and Marcus's comment about Medium articles is very resonant, because I feel like I've read 1,000 blog posts at this point, endless amount of time spent on Twitter, Reddit, podcasts until the end of time. I mean, that's kind of how when I kind of saw what was happening, and realized that we were kind of on the precipice of something big. That's kind of how much I threw myself into the space, because I think this is going to touch everything that we do at some point in time. And so, a lot of self-education. I think it was helpful that I had, fortunately taught myself a little code to mess around and kind of see what was going on. And also, cold emailed everyone that would talk to me to sort of get up to speed. And while I can't discuss specifically what we're doing internally, let's just say I've been getting a lot of the team up to speed, and also, kind of broadly advocating for why this is important. And it's such an esoteric topic, and a lot of education is required. And it's something like, it's almost as if you see the Matrix, and then you realize that there's a lot happening. So it's kind of like, it's obviously a very personal interest of mine, but I think I've spent a lot of time internally as an advocate, and kind of embracing the role of the crypto advocate within the team.
Thank you, Andrew. I want to start with a question that I think is very pertinent. Like, why aren't institutions yet allocating? And obviously, I think the reasons include familiarity with the space, and custody reasons, and regulatory reasons, volatility reasons. I really see the risk as perhaps not being involved. We're also used to venture capital investments where you can lose everything, but the upside is multiples. And I think if institutions think about it from that perspective, crypto is just perhaps a liquid way of investing in VC. But I would love to turn to you, Marcos. When you talk to your clients who are not invested, what is holding them back right now?
Yeah. So I'll mention a few things, and just to be clear, 3 years ago, these considerations were very, very widespread. I think 99%, if I had to take a guess, were repeating these. Now it's a smaller percentage, or at least they're willing to work around these because they understand the potential asymmetry here, and they understand it's an early stage venture space, as you said, with involving a new technology, an entirely new technology in some ways. So I think, number one, in my opinion, from what I witnessed and I'm witnessing, is lack of education and understanding of the technology and the potential use cases. A lot of people just don't understand what the use cases are or can be. They don't understand how the blockchain works. They don't understand why we need Bitcoin in the first place. they're having a hard time figuring these things out, and I think it takes a lot of reading and a lot of debating to get acquainted with these concepts. So a lot of folks are in the learning curve right now. The other, I think, is the people are in the institutional world are inherently conservative, right? They're worried. They're worried of making a bad decision, and they're worried of headlines. So, when you look back, there are many scams, especially in 2017, illicit activity. At least the history of Bitcoin goes back to some illicit activity. So they're hesitant to do anything. Why take the risk? The other is, that there's a lot of speculation, especially with the tokens. They worry about this sort of vol up and down and how it will look in their portfolios. And then, custody concerns is another one. That was much more prevalent 3 years ago. And regulatory concerns, I guess, also less so today, but they're still, one of the main arguments. In the end, I think, people need to have, especially consultants, I'm not on the consulting side anymore, but they need to have buy-in from their board or investment committee, at least to partially, right, to make it happen. And if they don't, it's hard for them to stick their neck out in a way, right, and recommend this. So, but with that said, I think that the past 6 months have changed the narrative, and now, committees and boards are saying, why didn't we invest in Bitcoin? Some of them are saying, it's up 15x since we last talked about it. Why didn't we?
It was so obvious.
Right. So yeah. So that's I think it's progressed a lot, but these concerns are still numerous out there. Yeah.
Well, what's funny is the three of us, Andrew, Marcos, and I, were on a panel last week, digital assets institutional panel last week, and we kind of joked that was our dry run, and this is the main event here today. But Andrew made it a comment last week, and he mentioned Jim Bianco's podcast on the Defiant, and I listened to it this week. It was excellent, and I think that's probably just an easy way of seeing the big picture, that it's not just about crypto, it's not just about Bitcoin, but it's much, much bigger. And of course, the rest of this conference is going to be all about that. Andrew, can we get your perspective? What inning do you think we are with institutional adoption, and what do you think is holding us back for the most part? Is it really just education?
Yeah, for those that haven't listened to Jim Bianco's podcast on the Defiant, highly recommend it. He articulates a lot of the issues very well that I've kind of seen firsthand, and he's kind of someone with a little bit more gray hair. So, and he's seen quite a bit. So, but to your question in terms of adoption or kind of acceptance, I think that there's still a big learning curve for most people. I mean, Marcos and I, we can talk about how much time we spent, and like in yourself, everyone just kind of getting up to speed. And it's like you don't get in shape going to the gym one day a week kind of thing. And that's kind of I feel like that's kind of the pace of how most of us kind of think about educating ourselves outside of what we kind of do on a daily basis, and it's kind of not sufficient. And so without something kind of direct, like without a Netscape moment, it's hard for most of us kind of sitting in, well, bluntly, kind of wealthy nations with functioning legal system and banking systems to kind of contemplate why this is powerful. Back to kind of what inning we're in. I mean, I really think we're in either the first or second inning. There's so much. I mean, we haven't, like I said, we haven't even hit that Netscape moment. So, and people are just kind of coming around to it. Whereas last time you could sort of dismiss it. Oh, you had a bunch of ICOs that were, basically backdoor security raises, and nothing happened because they all crashed to zero. There's real stuff happening. Everyone kind of turned away when the bubble burst, but there was a lot of stuff that was being built, iterated, and launched lately, and you're sort of seeing all that kind of come to fruition. So there's a lot going on. It's still early days, but nonetheless, given kind of our personal experiences of how much effort it took for us to get up to speed, and I still feel like I'm behind all the time.
Yeah.
It's education is very important.
Yeah, when I realize we're preaching to the choir here at a crypto conference, but it does feel like the choice to not invest is an active choice, right? Is it a choice to maintain the status quo? And I am by no means a Bitcoin maximalist, but the chance of asymmetric upside clearly far outweighs the downside. If you think about it in like a VC type context, I see right now a lot of money at the institutional level is going into credit, into private credit, and the upside is defined, right? You get perhaps high single digits. The downside is perhaps undefined. I think in the 2008, it might have been down about 30%, these equivalent type of 5 to 6% upside. And maybe the next time it will be about 50%. If you call that upside of 1, downside of 10, if you flip it around, crypto, I think, you could lose 1, you can lose your whole investment if you think about it the most conservatively, but the upside might be 10x. So that's just perfect. That's just asymmetry 101. And I think perhaps the risk is not investing. I wish we could almost drop this conference right into a long only fixed income conference to debate this, right? That's where they really need to be thinking about it. But maybe I can just go back and start to keep discussing this point because I think it's so important. What do you think are the recommendations that we should do as institutional investors to help our investors get to the point where they can actually underwrite an allocation to digital assets? Like, what is it? Just education? And if so, is it just continuing to do these panels, writing white papers, recommending podcasts? Is that going to get us to the next inning? Marcos?
Yeah, I think absolutely. And I think, a lot of people have been doing that, and including ourselves, for the past few years, but it's a very long process. Like, I feel for example, when I was a consultant, I think I did these sessions with the same group like 3-4 times. It doesn't stick with folks in one session, nor with 2 sessions. I think it takes time. I also think that the recent run-up in prices is going to be very helpful in getting people up to speed, because they're struggling now to read everything and understand everything, given what happened, what transpired the past 6-7 months. I think that's the most important thing, to be honest. Now, what else could you do? I think at that point, once folks understand what's going on there and start speaking with the managers and start thinking of how they could implement this allocation, I think you're halfway there. So it's education, and I think it's working. It's working slowly, but it's working.
I think to kind of follow up on that point, one thing that you may have picked up is a lot of self-education is necessary. But one of the things that I found very impactful is if you actually just engage with, let's just say DeFi as an example, directly with yourself. If you download a MetaMask, send some ETH there, and then see how these things work, and see that this is sort of a lot of prototypes for what sort of the next evolution of Wall Street could look like. I think you'll understand that, yes, there are a lot of bugs. Yes, it's clunky, like it's risky, but this is kind of a vision in progress. And by the way, it's iterating fast and in real time. And this is what you're going to be dealing with, whether you want to or not.
Maybe I should add one thing here. That's great. That's a great point, Andrew. But maybe I should add one more thing here. Maybe I mentioned it, but maybe give it a bit more color. If people had invested, and now hindsight is 2020, sure. But if people had invested, in the institutional world, a small amount across, different funds and in Bitcoin and so on in 2018-19, they would be sitting at 10x gains and so on now, assuming they didn't rebalance and other things being equal. You're not going to get these types of returns anywhere else, right? And even with traditional venture, only a handful of funds make 3x net, over a 12-year period, right? So I think, and the value accrual, at least for now, has occurred, in multiple protocols, multiple businesses, equity businesses, Dapper Labs and Bitcoin and Ether, different areas in the crypto space. So I think people need to take a hard look at what happened the past 2-3 years to plan ahead for the next 3 to 5 years. That's my 2 cents.
I agree. I think what holds a lot of people back is just this magnificent run up it's had, right? It just feels like we are investing at the top. You almost feel silly to bring it to your investment committee and say, here's an asset that's up 20x over the past 12 months.
Right.
And I would like to invest. But you would look even sillier, I guess, in a few years' time, if it goes up another 20. But maybe that's a good segue into portfolio construction. One of the challenges with crypto, I think, has been that it doesn't fit into the typical framework where we analyze stocks and bonds. A lot of institutional investors don't really know how to think of it because it's such a new asset class. Where do you guys see this fit in as a portfolio construction tool within an institutional portfolio? Is it going to be in VC? Are people carving it out of in its own bucket? Is it a 1 to 5% type of asset allocation? What are you seeing and what are you recommending, Marcos?
Yeah, so I've always viewed it as a VC subset, and with the tokens providing early liquidity, so a very idiosyncratic VC type of space because of this asymmetric and power law structure of returns, which is really VC. Now, I mean, you could argue that Bitcoin can be categorized in many different ways. Some people are thinking of it as a commodity or a hedge and so on. But in general, I think of this whole space as a subset of VC.
Even if you were just investing in Bitcoin with daily liquidity, you would have it in a VC bucket.
I would put everything under the VC bucket personally, just to have it all in one structure. And there's a menu of options here. People can do many different things, and I have a very specific view of how they should be playing, and I can talk about it. But you can invest in Bitcoin and Ether. You can do it directly even now. You can maybe with an ETF pretty soon in the US. You can also invest in venture funds. As a lot of these venture funds do both tokens and equity. Others do just equity and then have a separate hedge fund for tokens. You can do hedge funds that are venture-like. They hold tokens and but their approach is venture-like long-term. Then on the other end of the spectrum, you have the trading strategies, which are a very different ball game there. It's basically trying to extract alpha in these inefficient markets. Now, what can you do with all of this? I think, let's exclude the alpha strategies, the trading strategies, low net, all of that. But the other part is really VC and the value accrual can occur, in certain equity businesses. It can occur in certain token businesses. It can accrue in Bitcoin if it becomes digital gold. It can accrue in the Ethereum ecosystem. It can accrue with DeFi protocols, with NFT marketplaces. There's a wide range of potential, winners here long term, and then many other applications that we haven't seen yet. So the way I would construct a portfolio here would be I'd have as my core of VC structures. Because I think most of the best teams operate under VC structures, even if they're doing tokens. But I would also have some hedge funds. It's all about the teams. I would also have some hedge funds, and also to control a little bit of my liquidity as well to rebalance. And then I would probably own Bitcoin and Ether separately because I probably wouldn't have enough of that in the active manager piece. Now, final thing: why venture structures? Why am I so always been interested in venture structures, even when they're liquid tokens? You might say, why on earth do you want to do that? Like, you don't control your liquidity. But I think I agree with that. But I think it has certain great benefits. You can play offense, right, in the bear market. You don't face redemptions. If you had invested in a hedge fund that did tokens in 2017 and a venture fund that did tokens in 2017, you'd probably be flat, maybe 2x with the hedge fund now, and maybe 5 to 10x with the venture fund, because they spread it over time. They went into earlier stages. They did more illiquid pre-launch stuff. that ended up having very asymmetric returns. So, both in terms of the quality of the teams, the fact that you can access early stage stuff and equities, and there are opportunities across equities and tokens, and because you won't be faced with redemptions, and an institutional investor won't be able to redeem. You need to help them not do that, right, at the worst possible time. I think you can play for the long run. So I'd put the core VC, and then I'd have some hedge funds, and then some liquid, some Bitcoin and Ether. I'd hold them probably extra directly. That's the way I'm thinking about it.
Yeah. They always say one of the benefits of locking up your money as an LP for 5 to 10 years is that you're saving yourself from yourself, your own risk management, right? I think I would take a slightly different approach, and just sequentially, and I think this is probably what you're getting at, but sequentially for me, it feels like the risk is simply crossing over the divide into digital assets, and everything is going to be benchmarked to Bitcoin anyway. That should be an institution's first investment. And I think we've seen that along the lines, right? Because when you look at, I've probably seen dozens of crypto hedge funds now, and some of them are doing very interesting exchange arb. They're doing yield curve, cash futures basis type of trading. But the returns, even though they're better than traditional hedge fund returns, they're still only, mid-teens to 20% returns. And I think going to an investment committee to try to get this pure type of arb exchange type of returns is just not feasible, right? Because if we're going to be taking crypto risk, we should be getting crypto returns. But I think, Marcos, what we're probably talking about is the exact same thing. I think I would start with Bitcoin. That would be the very first, then move into Ethereum, perhaps some other liquid tokens, then diversify with venture capital, and then perhaps if you're really building out your book, start to consider all different types of satellite approaches. So you have your core, and then you've got your satellite. And I think as we evolve in the crypto ecosystem and things perhaps become less correlated to each other, diversification in that bucket will be even more important.
Yeah.
Andrew, what do you think? How are your institutional, the friends you're talking to in the institutional space, what are they looking at, and how are we getting there? How are we getting to this diversified portfolio, which perhaps, if things go well, in 10 years, every institution will have that type of diversification. 30 years ago, high yield was an asset class that wasn't respected, and junk bonds, it took a decade for it to be accepted as part of a corporate capital structure, and today every single institution owns, every asset owner has high yield as part of their investment allocation.
Yeah, no, I think that's a good analogy, and maybe, as you kind of said, junk bonds into high yield. Maybe there's a branding exercise that we could learn here as well. But anyways, most, I would say, of my peers that I've spoken to, similar lines as what you and Marcus just said, very much kind of venture capital type buckets because of the asymmetric risk return. So if anything, that's where I've heard most folks get involved, at least from the institutional side. From the liquid side, I still think there are some institutions that have moved in. I still do think that it's mostly kind of high net worth or family office types. And yeah, no, I completely agree. I think it's a futile exercise to kind of restrict yourself to one or the other.
Yeah.
I think this is going to be all encompassing, and this is something that Marcus has probably heard me talk about way too much, but I don't know if we've really figured out what the ideal kind of legal structure for a crypto fund looks like. They all kind of have their kind of pros and cons, but because of that, I think that you should have a kind of variety of exposure to tackle the space.
Yeah. I'd love to move into manager due diligence. All three of us have a history of hedge fund investment, and we're quite familiar with meeting the managers and going through the process. can we talk about anything that you see as significantly different when you're doing due diligence on a crypto manager? Marcos?
Yes, yes, absolutely. Actually, it is. I mean, there are many things that are similar to what you do when you due diligence a traditional hedge fund or a traditional venture fund. Absolutely, but there are other elements that are quite unusual, and I think that was also a hurdle for institutional investors, at least initially, to due diligence these funds. You know, the most obvious uniqueness here is that you have a mix of liquid and illiquid assets, right, in these portfolios quite often, you know, equity and tokens. That's one, and I can talk a little bit about how to diligence that. But then generally there are no track records. So I remember in 2018, 19, a few folks were saying, I want to see the track record. I'm like, there are none. You know, this is a new space. Like you need to go with your instinct here. It's early stage venture. You know, some managers do have angel track records, which can be very helpful, especially and by now, you know, many of them have, you know, a decent history. But in any case, you can go through all of that and see how they think, how they sourced the deals, how they evaluated them. But you know, typically in our due diligence as institutional investors, we have a long track record to rely upon. That's not the case here. You know, there are other areas that are idiosyncratic here. For example, you know, you need to understand the technical knowledge of capabilities of the team. You know, potentially their data science usage to track blockchain data and get specific insights. You know, network participation into these protocols. You know, managers who are just passive might be leaving a lot of value on the table. You don't have these situations in the traditional world. So understanding how all of these things operate and interconnect, it can be, you know, challenging, or I wouldn't say challenging, can be foreign to the traditional investor. But I think you get familiar with these pretty soon. So in the end, the diligence process is pretty thorough, even for crypto funds, I think. You just need to understand that there's much more uncertainty here than in other areas.
Yeah.
So that's from the investment side.
Andrew, anything to add?
No, Marcos, speaking of thorough, he kind of covered it all. The only thing that I might throw in is you're moving into a world where all of the service providers are different. So that's kind of a curveball. You know, trying to get understand the different custodians, trying to understand the administrators, trying to understand the trading counterparties. That's a new world. So, you know, that's something that you got to get comfortable with as well. But kind of like we had talked about in the beginning, you didn't have these sort of institutional grade infrastructure last go around. This go around, I think it's there.
Maybe I should add to Andrew's point here, and I think we talked about it, Andrew, the two of us, but as when we were initially doing due diligence in these funds, you know, back in the day, we were actually doing due diligence also on the service providers. You know, we were following up the service providers. We did demos on custody, how it works, like directly with the service providers. I think you do much less of that in the traditional world, right? Service providers are established. You don't do due diligence on them, like you don't call them up and spend many hours with them independently of the manager, typically.
Yeah, I remember when I first saw a crypto exchange strategy, I was very excited because I've covered fixed income ARB, convertible bond ARB, vol ARB strategies, and you know, an arbitrage, a pure arbitrage, is simultaneously buying and selling the same asset at different prices and locking in that instantaneous risk-free profit, right? And we talk about fixed income ARB, we talk about these types of strategies, when the truth is you're not locking these spreads in simultaneously, right? Digital assets are instantly fungible. So there is no investment risk in this strategy at all anymore. But you have operation risk. You've got money on different exchanges all over the world, right? So you've traded investment for operational risk. And my takeaway really was to try to remember to call it, fixed income relative value, because it's certainly not a pure arbitrage at all. And I think that gets into operational concerns. Like for us, I think that is the much bigger issue. The investment case is pretty simple. I think, and this goes back to why institutional investors are not investing. It's not because they don't think it can go up 10x. It's because there's other insecurities with their view of custody and things that are happening behind the scenes here. We have a couple questions that have come up, and this is a big one that is coming up a lot. Is energy consumption for Bitcoin mining a big concern for ESG investors?
Yeah,
I think what's interesting. Yeah, go ahead.
Should I take it first? Sure. I'll say a few things on that, and please don't quote my data because I've picked them up from the web and from managers. I haven't cross-checked all this data to make 100% sure that it's accurate. But yes, the answer is a lot of folks are upset with the headlines that Bitcoin is in particular, and proof of work in general, is getting with respect to the environmental impact. And I think there are a lot of folks who are hesitant to invest because of that. And as you know, ESG is a huge trend. So the crypto industry needs to address these concerns pretty seriously, because I think they could hinder adoption. Now, the reality of the matter is that, in my opinion, and I'm not a lobbyist nor a spokesman for the crypto space, just to be clear, but in my opinion, these articles and what is being written are provided completely out of context. And what do I mean by that? In the grand scheme of things, proof of work and Bitcoin energy consumption, from what I was reading, is kind of half of what, maybe that's from a few years back, but half of the energy consumption that watching YouTube and playing video games online, in terms of CO2 emissions, it's about half of that, or it was half of that a few years back. Also, there's, as you know, you need to look at what renewable sources of energy are being used as well, the mix. And a lot of them are being used in the crypto space. And third, you have this entire proof of stake world, which is I think at this point, the majority of crypto, which doesn't have that problem. So in some ways, if you have concerns about CO2, you need to think long and hard about many other exposures you have in your portfolio too. Sometimes I feel that when people bring this argument up is because they think Bitcoin is a worthless activity, and that it shouldn't be emitting even these little CO2 emissions. And
I wonder about this question, right? Because it does seem, to me, it seems like the concern over ESG is not so much a true concern over ESG. Like, was their concern over ESG sincere over all their other investments? It feels like it's kind of it's an issue that certainly needs to be addressed, and I think it will be. And what's so interesting is these are two of the big super themes of the institutional world, right? ESG is front and center, and so is crypto and digital assets are front and center. Yeah. And like the conundrum is itself, like for Tesla, right? That's kind of the crux of it, right? Because it slams into each other right there. I have just 1 minute left, and I would love to perhaps ask Andrew the very last question. Can you talk about China's effort with the digital yuan and global crypto developments in portfolio strategy? Like, how do you see that playing out? And unfortunately, we got only a minute.
Okay. Yeah, this is a massive topic. But there was a few articles, actually one today, maybe, or yesterday, out there about the China's CBDC, central bank digital currency, shorthand is DCEP. This is going to be very, very big. I also think that you know, they were kind of forced into this a little bit by Facebook's Libra, which ended up getting completely gutted. But you know, digital currencies are kind of here to stay. I think the misconception is it's sort of oh, if we have this, we don't need crypto anymore. And I think the decentralization aspect versus centralization is the key issue that folks that take that view don't appreciate.
Well, thank you, Andrew, and thank you, Marcos, and thank you to everyone who has tuned in. I'm looking forward to the rest of this conference over the next few days. This is the end of our session, but you know where to find all of us. And I would like to turn it over to Paul Veredit for the next part of the conference. Thank you, everyone.
Thank you very much.
Thank you.